Well, my next guest sees a phase for the market, sort of like a teenager going through a phase where they don't often make sense, can be weird, unsettling, and they change on you pretty quickly. I want to bring in John Hancock, Investment Management Co-Chief Investment Officer, Emily Roland. And Emily, so you're calling this sort of a teenager market, and I get where you're coming from. I also think it's sort of mercurial, right? So subject to sudden or unpredictable changes of mood and mind. Teenagers, even though they change up a lot, we kind of know why. Sometimes in this market, we don't know anything.
That's right. We've been in this kind of unusual environment where the data so far have been pretty disappointing for the month of April. We had consumer confidence hitting a 2-year low. The ISM survey data on services and manufacturing going below 50.
And how crazy was it? Not only did they go into contraction, but prices went up for both of them.
Exactly. So whiffs of stagflation. So the data have not been great, but risk assets, Charles, they love it because it's reviving hopes that the Fed can start cutting again. So we're in this environment that's very odd where risk assets are outperforming. High yield bond spreads are below 300 basis points. And you're seeing kind of not, growth at any price companies doing the best.
So part of this, you say, is that we sort of exited a mini cycle or mini phase itself where Powell, I guess, jawbone financial conditions, they've gotten looser. And then he said, listen, we're going to start cutting rates. And the market is like, to your point, woohoo!
Yeah, exactly.
But doesn't this go against what the Fed's trying to achieve?
It does. And we've been thinking about Fed policy. Do you remember the movie Fight Club?
Yeah.
Yeah. What's the first rule of Fight Club?
Never mention Fight Club.
Right. And so the first rule of Fed policy should probably be don't talk about Fed rate cuts until you need to talk about rate cuts.
Yeah,
so just by talking
I'm glad you brought that up because it feels he's defending it now.
Right.
Like that last FOMC, the question and answer period. He's like, he would never even acknowledge that maybe they have to hike rates. They're in a position where he can't say 3 maybe anymore, but he's really he's boxed in now.
I just don't think he can be a hawk. I think Powell's middle name should be loosening financial conditions, Jerome Powell.
Maybe we could think of
something better.
Something like that. So, so this is not helping.
No.
Of course, what we see with bond yields, that's not helping. And yet, outside of that hiccup in April, but there's still some interesting things, right? The market has still been concentrated with the big winners and the non-big winners. Value. Everyone keeps talking value. By the way, in January, everyone loves value in emerging markets. Every January, every guest, we love it. Why? It's underperformed for 24 years. Oh, okay. So value out of favor, looking extraordinarily cheap versus growth. Is this the time to start nibbling?
So we just talked about macro. This is really about the fundamentals and where the earnings are. And if you look at Q1 earnings season so far, it's been really disappointing on the value side. In fact, Russell 1000's coming in at -4%. Meanwhile, on the growth side, we're seeing booming earnings, and a lot of that's coming out of mega cap tech.
But a lot of folks are saying if you look at the rest of the year, earnings are going to come, like the 493 are going to go up. And some of that's comparisons, year-over-year comparisons, right? And there's no way the Magnificent Seven and those other big growth names can maintain that level. So now you want to buy value ahead of that, but no, it's too early.
No, we still like some parts of value. And in fact, we would be looking down in market cap on the value side. I mentioned Russell 1000, -4%. Mid-cap earnings on the value side are actually looking really good. So we'd go down in cap in value.
All right, what about bonds? What's the story with the bond
This
market
is my favorite chart.
Is it?
So one of the things that's been happening is we're experiencing a ton of bond market volatility. In fact, the 10-year Treasury yield just fell 25 basis points in just over a week. So what we would be looking at is any backup in bond yields as being a great entry point. In fact, you look at the aggregate bond index right now, yielding almost 5.3%. Look at this. It's close to the 20-year high. Right. The 20-year average is 3.25%. So you can get income right now.
Lock this in?
Lock it in.
Lock that in. Okay. So let's just talk one more thing. Oh, I thought I had an emerging markets thing on here. Anywhere else you'd be looking, though? Would you be looking at emerging markets or just stay with what's working?
Well, everybody's looking at emerging markets. China's up 20% since the January lows. First, it was policymakers inducing stimulus, buying their own stock market. But momentum traders have taken hold, and it's really moving higher. Probably oversold at these levels.
Overbought or oversold?
Probably, overbought at these levels. We would fade the momentum there. Ride out this phase. Remember your kids, this isn't really who your child is. You really know who the kid is.
Right.
And stick with those higher quality stocks.
All right, great stuff, Emily.
Thanks so much.
As usual, love it.
Take care.
Appreciate it.